And just like that, we're back. We're so back. Stocks of all shapes and sizes decided they wanted to be green when they grow up, and stock markets across the world put on a show, bewildering bears and giving bulls the last laugh. But will the rally continue, or was this an elusive dead cat bounce? As history tells us, around this time of year in bullish years is when we should start to get cautious, and with even more election uncertainty looming, is now the right time to hedge our bets or even outright sell in the face of today's rally. And today we're going to talk about that, as well as earnings, sentiment, and why Goldman Sachs are shifting neutral for the next 3 months. What exactly do they see, and is this the end of the road? We've got a lot to talk about. Let's roll the tape. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. So if you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Let's get into it. This is a daily heat map of the S&P 500, and we see very clearly a lot of green led by technology. Nvidia up 4.71%. Google, Meta, Tesla, they were all in the green. We saw a little bit of sell side action here in Amazon as well as Apple, but it didn't affect the broader market because software was up. Growth outperformed everything else here today, but we did see pockets of red. CrowdStrike was down another 13%. This stock 3 days ago was up 58% for the year. It's now pretty much flat, I believe, if not a couple percentage points up for the year after the situation that happened on Friday. Pretty much a software update, bad code, meant Windows operating systems couldn't operate at all. The market not liking that, and we'll see where this stock bottoms. But I think if you do like the name, this is a great opportunity for you to get in. I think this situation will probably make the company stronger looking ahead. Telecom services were very red in the face of Verizon's earnings. It was a bit of a dumpster fire. And then energy was also red here today, just giving some gains back after the outperformance last week. We saw every sector in the green except energy stocks here today, led by technology and consumer discretionary. And this is kind of crazy because the biggest component of the consumer discretionary space is Amazon. To see it actually up 1.1%, and the second best performing sector is kind of nuts when Amazon was red today. But industrials, real estate, utilities, financials, they were all up 1%, 0.9%, 0.7%. But we can definitely see it was a growth rotation, because if you look at stuff like staples, if you look at stuff like materials, you look at stuff like healthcare, they were up 0.1, 0.3, 0.6. And actually the underperformers here today, definitely a day for growth, but more importantly, a day for size. Smalls outperformed mids, which outperformed large. You can see that their rotation is clearly underway, but definitely a day for growth. 1.6% in small growth versus small value, and then 1.6% in large cap value versus large growth. But the rotation is clearly underway. You got to look for these small signs in everyday trade. Small core up 1.6% versus 1% here for growth versus 1.3% for mid caps. And then we look at value, small value up 1.5% versus 0.4% here for large cap value. So the rotation is underway, but it doesn't really matter because everything is rallying. And if you're in large cap growth, you're looking at the gains today and you're sitting very pretty. But this was the performance at the end of the day. In fact, at the start of the day, the IWM, this white line right here, was actually negative. So too was the equal weight and the Dow Jones. A large part of the market was actually red up until about 10 o'clock, 10:30. Then things started to change. And that change was as a result of volatility. Around 10:30, we saw a massive crush in volatility. VIX was down 9.75% today, coupled with the fact that yes, yields were rising, but around midday, we actually saw yields pull back from their high. So when yields go down, volatility gets crushed, stocks are going to do very well. And that's why we saw the IWM make some lows here around 10:30 and then continue a rally, breaking the day's high, breaking the open of the day, and rallying to above the 220 level. And looking at the daily chart in the weekend video, we said two things could happen. We could either just see a rally from this position right here, or we're probably going to go to this 210 level. Either way, we said we do forecast a rally back to 52-week highs, and that's kind of what we're seeing, a very strong rally here in the IWM, up 1.59%. But it wasn't just small caps. The RSP was up 0.79% and actually bouncing off this 168 region, the same region where we used it as support at this high right here in early mid-May. and at about the all-time highs that we made in April, at about that level right there. So I think we probably go up, bouncing at a very key level, very technical levels. And if we go ahead, break the 169 area, use it as support, we can look at these levels here at all-time highs. In the face of small caps and the broader market rallying, we saw gold was flat today, silver was down 0.36% and back to this $28 level. This is a very, very strong zone right here. If you missed your entry on silver, now is probably the time. Crude fell 0.31% and the dollar was flat, coming off a firm day on Friday and Thursday. Now, very interesting developments for the S&P 500, which was up 1.08%. In the weekend video, we said 5,500 was an absolutely critical zone for the S&P 500 because that's where we actually saw the gamma flip zone. So the gamma flip was at 5,300. It moved up to 5,500 and we said two things are going to happen. Either we're going to bounce right here at the 5,500 level, and that would be a good thing. That would open up all-time highs and the call gamma resistance at 5,750. It does look like that's what is happening in the S&P 500 right now. Or we were actually going to break below the 5,500 area, look for a move down in the put support, which is now at 5,500, and look for a move down to 54, maybe 5,300, and that would be our target. As it is right now with the gamma situation, things are looking a lot less grim than they did on Friday, but we do have to hold this line of support. So as it is right now, 5,500 is both the put support and gamma flip. It's offering strong support, and this does look like a support zone where the market is going to use to bounce off and continue the rally into the 5,750 area. Now, do take into consideration, guys, we are in the window of weakness, which means that these dealer supportive flows are not quite as strong as they would be at the start of the month. But if we do actually dive deeper into the day's trade and look at the candle structure and location, what we see is a huge gap up and go. Very minimal wick here at the bottom. The bears did try and take us down. They did try to sell sort of the high of Friday, but bulls were resilient and we did actually move our way higher up into very close to the halfway point of Thursday's candle right here. Very, very bullish, and this was the zone where we capitulated off. If tomorrow we continue the bounce in the S&P 500 and close in the upper third, maybe at the high of this candle, that probably opens up new all-time highs, and then that would open up 5,750, the core resistance. But if we are to find a bit of weakness, which we did see a tiny bit, we saw a tiny bit of selling at the top here, I would then look to 5,500 as our line of support. But diving into the 5-minute chart, you could actually see that a lot of the selling we saw predicated at the top wasn't really selling. It was probably just people getting out saying, hey, I've made good money off this bounce right here, off the gap up as well. I'm just going to take a bit of profit. We'll have to see what the Asian session brings. As it is right now, there's not actually much to say about the S&P 500. Our 5,500 area, which was our line of support, you know, it was above it, we're bullish. Below it, we're looking to this level right here. We are above it right now, but we need to see further price action. And that further price action is actually going to come at the 5,600 area. If we bring this over again, you can see this pink line right here. That is the gamma flip right here. We are still technically in negative gamma below the 5,600 area. And the price action in negative gamma tends to be quite volatile. So what needs to happen tomorrow is that we need to rally to the 5,600 area right here. We need to make a rally, make a stand. Maybe not tomorrow, but this week we need to push up to the 5,600 area, break above, and then use that as support. If that happens, we probably go back to 5,750 because then we can be buyers of dips, sellers of rips. But below the 5,600 area, guys, anything can happen. But it does look like for now, the 5,500 area is a very, very strong line of support in the market. But this strong line of support can definitely come undone if the put support does decide to move lower to the 5,400 area, if we do find resistance at the 5,600 area. So in negative gamma, the market can get erratic, but as it is right now, 5,500 is offering support. Those that are long are sitting pretty on their longs. And as long as we go ahead, break above 5,600, it opens all-time highs and it opens up 5,700 up here, which is kind of crazy in the context of what the S&P 500 has done this year, which is up 16% since January 1st. Absolutely crazy, onward and upward. But let's talk about things that can actually move the market this week. Earnings. Now we have a huge week of earnings. It really kicks off tomorrow. Spotify, UPS, GE, Coca-Cola, GM, Visa, Alphabet, Tesla. we have a lot of names reporting tomorrow, so it's going to be a big day of earnings, both before the open as well as after. And then Wednesday as well, we have Chipotle, Ford, ServiceNow, IBM, AT&T. And then Thursday, we have some big names. Friday, we'll tackle them a bit later on in the week. But today, we're actually going to have a look at Medpace Holdings. Now, you might be thinking, why are we doing that? Why not Cadence Design Systems or NXPI? Simply because a ton of small cap quality ETFs hold this stock right here. You know, I've been a champion of small cap quality, and Medpace put out very mixed earnings here today. They beat on EPS 275 against 252. That was the expectation, but they missed here on sales by about 528 million revenue against 529. That was the street's expectations. They also lowered guidance. This is one of the higher quality names in the IWM. So to see these results, very, very mixed. You can see they were up 3.77% on the day, down 15.94% in after hours. The street not liking this at all. Missing on sales, missing on guidance, lowering guidance. Not a good look for Medpace at all. And we're going to have to see how this affects small cap quality looking ahead for the rest of the week. I am still bullish. This doesn't change the overall thesis, but this can throw a bit of a spanner in the road, mostly in the form of time. But you do have to look at these figures, right? Medpace, this company is still growing at like 16% year over year, and this figure is still for like 13% growth for the year. They just decreased their growth from 13.5%. So the company's still growing. Fundamentally, the company's sound. Great fundamentals in this company, just the market not really liking these figures right here. And yeah, these figures were a bit of a dumpster fire, excluding EPS. Guys, diving into sentiment, something we do every single week on this channel if you're a subscriber. So we do a weekend poll just to gauge where sentiment is. I've been mixing up the questions here and there, and this week's question was, for the Russell 2000 this week, are you bullish, bearish, or neutral? 573 of you voted. 50% of you are bullish on the Russell 2000, and I understand why. 29% of you were bearish, and 21% of you were neutral. And I totally get why 21% of you switched neutral, particularly with the price action we saw at the end of last week. And Goldman is actually in the same boat. They say we remain modestly pro-risk over the next 12 months, but are shifting neutral for the next 3 months. So this is a 3-month horizon, 12-month horizon. And you can see they've switched neutral for equities across global equities, cash neutral, commodities neutral, government bonds neutral, credit neutral. But over the next 12 months, they favor being overweight equities, overweight commodities, underweight credit. Very interesting positioning. So they're neutral in the next 3 months, and I guess that has to do with seasonality as well as the election uncertainty we're seeing in the market right now. And generally speaking, this time of year, from late July, August into as late as October, we tend to see an uptick in volatility. This is VIX seasonality. And the second volatility goes up, equities tend to move lower because the VIX and stocks tend to have an inverse correlation. This is what we've done here in 2024. And while seasonality is not a crystal ball, it does allow us to assess probabilities, and we can then say it's more likely than not that we are going to get volatility, but it should just be an opportunity for us to buy the dip, because as it is right now, earnings are looking quite stellar, 11.1%. That was the expectation at the start of earnings season, and while revenue is coming in pretty much in line, so too is margins, but it's still early days. Only 70 S&P 500 companies have reported earnings, guys. And at the same time, August tends to see quite a lot of volatility, especially when we've had a positive May to July. In that instance, we can see August returns negative 0.57%, negative 0.65%, 20 up years, 26 down years. So if we do see volatility in August, and potentially volatility to as far as October, it's actually well within seasonality and well within what markets normally do in a bullish year. So let's talk about the macro. So we have a big macro event this week. GDP for the second quarter is releasing, and just a couple of weeks ago, GDP was looking grim, coming in at 1.8%, but we've seen slight improvements here in the economic data, and BofA is expecting a 2.3% GDP. The Fed's GDP now tracking is looking rather similar, slightly more upbeat, looking at like 2.7% against the 2.3%. And I guess the truth is somewhere in the middle. And this week, we are going to pay very close attention to economic data. If we get US services PMI, manufacturing PMIs come in weaker than expected, as well as durable goods come in cooler than expected, that is going to affect the GDP print, then we likely get the consensus expectations versus BofA's expectations here of 2.3%. But if these come in line, services manufacturing PMI, let's say we get new home sales that are slightly upbeat and durable goods in line, in that situation, we probably get the 2.3% GDP over the 1.8% consensus. And I think that's actually going to be positive for the equity markets. We know that inflation is coming down. If growth remains robust with rate cuts on the table, that's a very positive environment for equities, especially if PCE coming cooler than expected. And we do think that PCE is going to cool, because we can see that 2.6% was the previous, 2.5% is the likely estimate right now, which means we are going to continue to see disinflation coupled with stronger GDP. That's a great backdrop for equities. However, that does not mean we won't see volatility, because oftentimes uneventful macro weeks are the best weeks for stocks, and this is not an uneventful macro week. This is an eventful macro week. We have plenty of macro data. We have PCE and GDP, two major macro events, plus everything to do with earnings, and this is often the worst week for stocks. We often return 0.02%, and I'm assuming a pretty low hit rate. Now, in this week's data, US services PMI and US manufacturing PMI is expected to come in at 55 and 51.2. Now, anything above the 50 line is actually an expansion. Anything below is contraction. And we have actually seen quite the manufacturing recovery in the last 18 months. And this, coupled with rate cuts, has historically resulted in the SPW outperforming the S&P 500. In other words, the equal weight has outperformed the S&P 500 market cap weight when we've had a lower rate environment and improving PMIs. And this is starting to take shape under the hood. If we just dive into relative performance against the S&P 500, we have the 11 major sectors from consumer discretionary all the way to utilities, and we can start to see a real difference. You start to see these fish hooks here at the bottom of these charts. Pretty much all of these charts have been a little bit of a dumpster fire against the S&P 500. If they're going down, the S&P 500 is outperforming. These charts are going up. Said index or sector is outperforming. You can see that infotech and comm services have really outperformed this year. Every other sector that has not been the case, except very, very recently, we've seen relative outperformance in industrials, energy, materials, real estate, staples, healthcare, utilities, financials, pretty much everything that isn't tech or software related. We are starting to see that rotation take place. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Cheers.